Hi, Stuart here. What I'd like to talk about is how do the banks set interest rates? Well, there's three criteria in which that influences the bank. The first one is the risk-free rate, which is set by the Reserve Bank of Australia, or RBA, and it's called the cash rate. And so each month, in fact the first Tuesday of each month, the RBA meets to talk about whether they should change the cash rate. And if they do change the cash rate, it immediately impacts the bank's cost of funds. So that is, if they increase the cash rate, it means the banks have to pay a higher interest rate when they borrow money to then on-lend it to you. And of course, they're going to pass on that higher cost. The RBA's job is to keep inflation within the 2 to 3% band. So if inflation's getting too high, the economy is getting overheated, they'll increase interest rates, and the reverse is true as well. The second thing that influences interest rates is the bank's cost of funds. So how much does it cost for the banks to go out and borrow funds? Now, obviously, as I've just talked about, the cash rate or the risk-free rate is a proportion of that. The other proportion is what they call the credit spread. So that is how much over the risk-free rate the bank needs to pay, and that's dependent on their risk and also dependent on international and domestic money markets in terms of how buoyant they are or how much demand there is for interest rate securities. Other things that influence cost of funds is how much the bank needs to pay for on-deposit monies. So if you go and deposit some monies with the bank, they're going to pay you obviously interest, term deposit and so forth. And so how much they need to pay you and how competitive is that space. And then the bank's going to borrow on a short-term basis as well. But really it's the risk of the bank, so its credit rating and the healthiness of the money markets that really determine that part of the interest rate cost. The third determinant on interest rates is competition. So obviously in a market with a high level of competition, people have to compete on, or businesses have to compete on a broad range of different things, and price is one of them. And price for a bank is the interest rate that it charges. So the net interest rate margin, which is really the difference between what the bank charges you and what they pay, is around about 2%. So the bank's making about 2% on your mortgage, and that needs to go towards paying their costs and so forth. Net interest rate margins in Australia are pretty fat and healthy in comparison to the rest of the world. So in the US, they're smaller. In the UK, I believe they're pretty close to 1%, mainly due to competition. So that really drives that mortgage rate lower. So remember, there's the risk-free rate, which is the cash rate by the RBA, the credit spread, which is how much the bank has to pay above the risk-free rate to access borrowings, and then the level of competition. What you'll find is that banks tend to be more competitive when it comes to fixed rates. And the reason for that is that their profit is more known. If you lock in your mortgage for 5 years, the bank knows exactly how much they've paid for that money and how much profit they'll make from you. And therefore, they're more prepared to play with that margin to win your business. So now when you watch the news or read the newspaper and you hear about interest rates and RBA and the money markets and so forth, you'll have a vague idea about what they're talking about. Okay, so if you want to know more and master the game of building wealth, grab my book, Investopoly. Until next time, see you later.